Hey guys, this video is going to address the dollar index situation where I expect the dollar to be going in the next several days, weeks, and months. So we're going to have a little outlook and a little insight into our directional bias of the dollar, our main directional bias, and what we could alternatively see in the dollar and how we can prepare for such an outcome in both instances. Now, let's have a good look at the dollar index on the daily time frame. Right? Our main count from the daily time frame on the dollar index has always been bullish, right, guys? We've been bullish on the dollar ever since the market hit a low during January 2021 and since formed this leading diagonal. Now, the most important part and the most important factor about the dollar index as of now is the fact that the market looks very clear from an impulsive structure. We have several divergences. Also, one divergence that I have mentioned is the MACD divergence, how we have turned from bearish divergence. Well, I'm not going to say divergence, how we turned from negative MACD to positive MACD. And the last time this happened, right, was during the bull run of 2018, right? Notice how every time the market has turned bullish, or every time the MACD has turned positive and the market has turned bullish, we have seen a sustained bull run. It's also happened during 2014 and it's also happened during 2008. So we need to take this sign on the dollar index as something of some importance, to at least something temporary. In previous history, we've never seen the market turn bullish and then negative again, apart from when it happened in 2012. So, yes, this could potentially be a corrective wave. That's why we have two perspectives of the dollar and we adjust ourselves to which one is more probable. Now, as far as I'm concerned, guys, the broader market perspective looks bullish, right? Majority of dollar pairs do signify a bullish continuation. Now, the best way to approach this, guys, the very best way to understand whether we are going to see a bullish dollar in the future or a bearish dollar in the future is by looking at several markets, right? The two markets we need to look at are gold and 10-year yield. These markets will give us an indication of the probability of the future dollar strength or future dollar weakness, right? Using the wave principle, we can give ourselves an indication of how far the dollar may go or how far the dollar may not go, or that's how we gauge using the dollar index, right? Or using gold and using the 10-year yield, but we use it in combination because there has been times when gold has moved higher and the dollar has moved higher, and vice versa. So we use it in combination. We can also use the stock market, but the best way, guys, right, even apart from using gold and also the 10-year yield, is to look for a break of structure. Easiest way. Now we're going to dissect the dollar index on the daily time frame first before we move on to our perspective on gold. Now, looking at the dollar index, guys, it's very clear to see that we've completed a 5-wave impulses wave 1 here, and we've completed a sharp correction. Now, what's more important here is that this can still be a leading diagonal, a 5-wave leading diagonal, or just a 5-wave impulse in manifestation. Now, if that is the case, then we will see another move. We'll see a 3-wave corrective move lower here, and then we'll see a move higher before we see a deeper correction. So this would then invariably complete wave 1, and that would see a correction for wave 2. This, however, also could be the end of wave 1 here, and the end of wave 2, and we are subdividing the impulse, and we're due for another correction here, which is the most likely bet in this instance. And we are preparing for a move higher for wave 3. That is the most likely bet in this current scenario of what the dollar index is doing. Now, If you look at the alternative, we can say to ourselves, okay, here's the dollar index now on the daily time frame. We have in fact completed an three wave corrective sequence and ABC pattern since we have made a new high, right? However, the only thing we haven't done is we have not hit or rejected of any Fibonacci ratios. So if you used to plot a Fibonacci retracement, we haven't actually retraced uh, by any Fibonacci proportions. Whilst this isn't necessary, usually it's ideal for corrective waves. Now, putting this into perspective again, putting this onto the hourly time frame, we can see how clear the market structure here has been for the dollar index during this uptrend, right? Now, if we add uh, these variables here and we go back to the 4-hour time frame, we can see that in all this alternative scenario here, we've managed to dissect and understand a 5-wave structure here on the dollar index with wave 1, 2, you got wave 3, extended wave 3, which is very clear, wave 4 and wave 5. Now, the most important part of this structure is the fact that all the characteristics, rules, and guidelines fit the wave principle to perfection. So we can't go and say that this is an incorrect way of doing it, because as far as we're concerned, the rules and guidelines fit perfectly. Now, say for example, we wanted to understand whether the dollar index is going to fall and break structure and fall lower uh, for a bear market phase, or if the dollar is going to bounce and move higher for a bull market phase. Well, the best way we understand this is we look for a break of structure. We wait for the market to play its hand. During the second wave degree correction, what we want to see is quite simply the dollar just form a three wave correction. We want to see a three wave correction. Now, here's the most important part. We know three wave corrections signify corrective sequences, 5-wave impulses signify trending phases. Right. So far, this does look like a sharp 5-wave impulse. So we need to see a pullback before we even see a drop lower. If we see a drop lower from here, we have two options. This could also be a corrective flat, or it could just be um, the start of a new 5-wave decline, as we have here. How would we know? Well, firstly, what we want to see is a break of this wave 4 as a signal to the potential for price to fall much, much lower. That's the first signal. The second signal would be the break of this wave B. This would be ultimately the best confirmation that we have, and this would indicate to us that the market is prepared to fall lower. The beauty about using the wave principle for confirmation is that you can use structures to identify when the market could potentially be changing trend, or when the market is now confirming a new trend. So the same would be applied to our bullish count. We wait for the market to form a three-wave correction, and then we wait for the market also to break the wave 1 high. When the market breaks a wave 1 high, this will signal to us that this is in fact an impulse wave sequence in progress. And because the market would then be signaling to us that an impulse wave sequence is in progress, we can now prepare ourselves for what the market may be doing next. So, as I mentioned before, we can also use gold and the 10-year yield to indicate to us the bullish potential or the bearish potential of the dollar. Now, a quick glance at gold will give you guys an indication of what gold is doing right now. So far, gold is in an impulsive sequence on the daily time frame. Now, looking on the daily time frame, we can see that the market has formed an expanding diagonal as wave 1. We have then formed a nice zigzag correction as wave 2, and we have now forming an impulse wave sequence as part of the intermediate degree wave 3. Most importantly, however, is this sharp move higher for this C wave, which is indicating to me that this is a temporary flat correction. Most importantly, guys, what this also indicates, right, on the gold futures exchange, that this isn't, right, a start of a new move higher. Whilst it could be the start of a zigzag correction here, and we could be seeing a corrective wave occur, the likelihood of this happening is very, very slim because of the lower degree waves and because of how sharp this up move has occurred. This signals to me, guys, that this is setting up for a wave free decline in the near future, and we should be expecting gold to drop very vigorously once the market has completed this impulse wave pattern as wave C. This leads me to believe that the potential for the dollar index to rise is much greater based on this wave count than the potential for the dollar index to fall because of what gold is doing. Now, of course, if gold does form a zigzag and we see gold move exponentially higher, so much more rapidly higher, this would then tell us that gold is may possibly be turning bullish, and this could be the end of the correction as we fall, and we could be seeing a much more bullish gold. This would then indicate, guys, that the dollar index is set to fall much lower. So the most important part here, guys, in identifying the potential for this market is to wait to see for breaks of structure. I would first wait to see for this five-wave impulse to form right towards the 618, and then a three-wave correction right for this market, and then a continuation higher if we are going to see a bullish case. However, if we see the market rise towards the 618 for the end of wave 5 on gold, and we see the market continue to fall on gold, then this signifies a much more stronger dollar and also a rapid decline in precious metals. Finally, another market we can use, as I've mentioned before, is the 10-year yield, which is one of the benchmarks that a lot of people use. Now, on the higher time frames, we have indicated that the 10-year yield is bullish so far. The structure still remains bullish. We've seen a nice reaction from the lows, and I suspect the 10-year yield is going to continue to manifest and move towards new highs, especially towards this 2% or 2.4% yield mark. This would indicate a stronger dollar. Why? Because at the start of January, where we saw the 10-year yield move rapidly higher, we also saw the dollar move rapidly higher at the same instance. We saw a massive breakout, a correction, and the dollar move higher, whilst the 10-year yield moved higher, right? During this time, stocks did also move higher, but not exponentially higher. Then, ever since the correction, we have seen the dollar make a limited strand of upside movement. So the upside movement of the dollar ever since the 10-year yield has moved lower, right? As you can see here, the how lethargic basically the dollar index has been in terms of its potential upside movement has been decreased because of the downside in the 10-year yield, which is why I've mentioned before watching the 10-year yield can be key as a benchmark for what other markets can do, especially the dollar. Now, for a bullish dollar case, we want to see the 10-year yield move higher. For a bearish dollar case, we want to see the 10-year yield move lower. This will be most important, guys, for identifying and engaging the potential for the dollar to move higher significantly and exponentially. If you guys are wondering how to play this, it's very simple. Wait for the market to play its hand. I hope this video was beneficial. I enjoyed making this video. Look out for more videos on the dollar and the next one, which will be on the stock market. That's all for now, guys. Take care, and I'll see you on the next one.